As it's been 13 months since I've made a video on this channel. I'm going to talk about where I've been at the end of the video, but I want to do a quick market update for you guys. I know it's been a while. I've been asked a few times to do one, and people have been wondering if I'm okay and what I'm up to. So definitely want to get into that as well. So real quick, obviously we've had a bear market. Now, has it been as dramatic a bear market as the perma bears probably wanted? No, I don't think it has been. Was it a necessary thing? Yes, absolutely. We had way too much excess in 2021, 2020. And the Fed went nuts with QE. And the Fed has finally done the right thing with quantitative tightening, and I hope that they continue. They went on with QE for way too long. And finally, we're getting what they should have done a long time ago, which is tightening and reduction of the balance sheet. So glad to see that. And what it means is if we do get another bull market, which we eventually will, it won't be as nuts and parabolic as the last one. But what about right now? What are we looking at right now with this market? Well, DIX is an indicator that a lot of people don't trust at all anymore. And I understand, because in this market, it has worked exactly the opposite as it did back here. Back here worked entirely different than it does over here. I think we can probably say that now, right? Pretty confidently. However, if you were to put a moving average on this, this is an incredibly high level up here. Does that still mean that we're bullish long term? For me, I think the answer to that is yes. However, I think we're still going to be stuck range bound for maybe another entire year with this market before we eventually go bullish. That's my current view on this market. Now, as for DIX, when we look at it, as you can tell, it is gotten very bullish at local peaks and gotten very bearish at local lows. And currently, it's still kind of bearish. So what's that mean for the current price action? Well, if you were just looking at this, you would expect maybe price to go a bit higher until DIX got bullish again, and then we would drop down, potentially, right? But let's look at a lot of other things. Now, I do want to say I'm not going as in depth with this video as I used to do with my previous videos, because I'm still working back into getting into the market, and I'll talk about all that towards the end. Fed balance sheet, obviously coming off, and then we had a little bank scare and it bounced, but it'll continue to roll off most likely, barring some more issues, which, like I said, I think that's the right move. And is it not necessarily great for the short term? No, it's usually not, but it's the right move. So I hope they continue with it. It looks like, and this tool's been pretty accurate, as of now we have one more rate hike priced in, and then we stay there for quite some time, and then in November potentially we might even see rate cuts happen. Now that's obviously going to be dependent on the data, and by December we could be off a couple percentage points on the Fed funds rate, December of 2024, next year. So they are pricing in eventual cuts. Now the balance sheet, I assume, will continue to roll off even when the cuts start. Smart money, dumb money indicator has been pretty dang accurate in this bear market. So here dumb money got very bullish and the market rolled over. Smart money was kind of mid at the low here. Dumb money was very bearish. Smart money was very bullish. This is the absolute low of this bear market. I think we're off more than 20% at that point. And then again, same thing here. Dumb money gets bullish again at the highs. Smart money bearish. We had a pretty decent correction. And again, we get to the lows. Smart money quickly gets bullish again. We get a nice little rally. And now smart money is about as bearish as it has been in the last year. Almost as bearish as they were here. It's really hard to look at this and not think we're getting another correction coming. And dumb money is again bullish as well, adding to that. Same with the optimism index. This combines several different things: put call ratios, fund flows, positioning. A lot of the same things that are in the smart money, dumb money are in this. And again, this is suggesting potential pullback. If we go to the home page here, the excess return is predicted minus 0.9%. So that's essentially your back test for the current level of smart money, dumb money. Fear greed, it's a local high. This has been pretty accurate. You know, local highs and local lows have been at almost every major pivot point in this bear market for this. Bull bear indicator. This is more of a long-term indicator. It's been pretty accurate during the QT times. times. Currently, it's very near extreme bear, and it hit extreme bear at the lows and was there for quite a while. So this is, to me, a long-term bullish indicator, but in a different environment than what we had previously. It's in a QT environment, not a QE environment, so do not expect a raging bull market. If we do get a bull market, expect something like maybe 2017 maybe, which was a real slow grind higher and kind of ended with a bang, and then Volpocalypse. Could be something like that, or even slower, I would imagine. A very slow trend higher if we do get that, which I think that's not coming for another 6 months to a year, is my current prediction. City panic. People were all excited about how high this was for so long, and now it's finally into bearish territory, but not drastically bearish. Insiders are currently a little bearish, so this adds fuel to the fire of a pullback correction type thing. Not panic in the streets, not full-on crash, I don't think. Certainly possible, especially given the environment we're in with lower liquidity and things like that. Yeah, it's possible, but not what I would predict to be happening. I just predict more range bound and a test of either the intermediate or the long-term low. The AIM model, so advisors, investors, this combines AAII and a lot of different indicators all into one, which is kind of handy. The sentiment trader does that, and again, they're getting a little bullish here, and previous times they've been bullish. It's been a while, but it marked a fairly major significant high and been fairly accurate as an indicator. Short interest, everybody was all excited that there was no shorts back in the bull market, and they were absolutely right. There was no shorts. There was systematic destruction of shorts during that euphoric kind of run we had. But shorts are getting back there. They're still nowhere near like what we've seen in major panics, but high enough to suggest that it's going to be hard for this market to just collapse. Shorts are kind of an insurance policy against a market collapse. And margin debt was another thing that people were all excited about, and it has pulled back to a local low and pretty close to where it was throughout most of the 2010s. And when you adjust that for market cap, it's at a local low for sure. And the short interest on NASDAQ is near an all-time high. So that's a positive long-term for the market. Leveraged shorts are near an all-time high. That's a positive long-term for the market. Leveraged longs are at a local low. A little bit of a pickup here, and long-term, they're still arguably way too high, but I don't know if you're ever going to get these much lower because leveraged ETFs weren't really something that were tradable until probably in the 2020s. So you're probably never going to get this level again because people didn't really even know about them or trade them back then. Equity hedging index, lowest level we've seen in quite a while, suggesting to me correction could be on the way. Now I wouldn't be shocked if we get a little stop run to take out some of these shorts that I've been showing you guys, maybe a little bit higher high, but we're currently in a sideways ranging period for the S&P 500, suggesting a breakout or a breakdown is imminent. I wouldn't be surprised by a false breakout and then a little correction. Potentially is a somewhat big correction if it goes and tests the lower lows. Inverse ETF volume, quite high for quite some time. And again, inverse ETFs only got popular maybe 5 to 10 years ago. So don't expect it to ever get back to these levels in the next bull market. Hedgers combo, COT. So when hedgers have gotten extremely long in the past, it's been very bullish, and it's for the most part continued to work out in this market. And you can see at the highs, they were for a very long time they were short, and then at the lows of the COVID crash, they got very, very long. Before the crash, they got very, very short. This has been a long-term reliable indicator. This is very bullish long-term. Major index combined hedger positions. Same thing, basically, they're as long as they've ever been. Insider buy sell. So we looked at the insiders earlier, adjusted for seasonality. They're still selling pretty aggressively here. Bearish short to intermediate term. SPY liquidity premium. In essence, what this indicator means is when people flock to SPY instead of stocks, you usually get a low in the market, or it's bullish, at least intermediate term bullish. And now they're at a level that's not as bullish. Consolidated equity positioning, it got very low at the lows of this bear market. Currently, it is near a local high, but still net short, or below average, I should say. It's probably not actually net short. Fund managers are quite bearish. If you look at COT and the commercials, I do not have that chart in here, but they're the commercials and the dealers are quite bullish, but the speculators are quite bearish. Aligns with this chart. And the daily news is quite bearish these days, and of course that can mean long-term good things historically. And I just realized I did not have my camera on the whole time, so I'm going to put my camera on. All right, guys, so the bottom line for what I've been doing for the last 13 months is, one, we're in a bear market, and I started out trading okay, and then later on I didn't trade very good, and I've never traded good in bear markets. I'm just not wired for it, so I just kind of decided to step away. Ended up, I was going to step away for just 3 months and then start doing videos again and be active in the Discord again, and it just turned into 13 months. And to be honest, I kind of burnt myself out, because making these videos and making the book and the Discord, it was just a lot of work, and there's no real reward for it. I do most of it for free. I do sell the book, but I don't really promote it, and I haven't sold very many copies of it as far as that goes. So most of what I've done in terms of public, trying to share the knowledge in terms of trading, is kind of on my own time. And I did a lot of it, and I burnt myself out. Not just doing these videos, not just the market updates, not just the Discord, but just all the research that I constantly did for my own trading. I honestly just burnt myself out on the markets. And so basically in this bear market, I kind of waited for a pretty decent washout, and I just got long 1x leverage the market, and that's where I've been for over a year now. Just kind of 1x leverage and just sitting on it and not even trading. And I'm still not trading. And I do think decent chance of another pullback here. However, I'm not going to do anything with it. I'm just going to sit tight, and I'm slowly getting back into the markets and getting ready to start trading again, but not yet. So I still work full-time job, and so focused on that. And I've been working on a few other YouTube channels, which I will link in the description. That's something that's been taking up a lot of my time. And just working on other things, other hobbies, and things like that. So going to try to do one of these videos a month. That is the current plan for you guys. And trying to work my way in slowly and not burn myself out this time. So with that, guys, I hope you enjoyed the video. Subscribe if you liked the video, and I'll see you guys in the next one.